Ever wondered if you can turn your pocket change into a fortune? Well, let's dive into the world of small investments to explore this possibility. You might be under the impression that investing is reserved for those with bulging wallets. However, that's not the case. Small investments are not only feasible but can also be incredibly potent. You see, the key here isn't necessarily the amount you invest, but rather the habit of investing itself. It's about consistently setting aside a portion of your income, no matter how small, and letting it grow over time. Now let's talk about compound interest, a concept that Albert Einstein famously called the eighth wonder of the world. In the realm of investing, compound interest is your best friend. Imagine planting a tiny seed in your backyard. Over time, with the right care and patience, it sprouts into a robust tree. Similarly, when you invest, your money grows, and the returns you earn are reinvested, causing your wealth to expand, much like that tree. The beauty of compound interest is that it can turn small, regular investments into a significant sum over time. Let's say you invest a mere $20 per month. It may not seem like much, but with an average annual return of 7%, in 30 years, you'd have close to $40,000. Small investments are like building blocks, each contributing to the construction of your financial future. They allow you to dip your toes into the world of investing without risking large amounts of money. They also offer the flexibility to experiment with different investment options and strategies, helping you learn and grow as an investor. In essence, investing is not a privilege reserved for the wealthy. It's a practice that can and should be adopted by everyone. And remember, when it comes to investing, it's not about timing the market, but time in the market. So, small investments can indeed make a big impact. How do you feel about that? Now, what are some common myths you might have heard about small investments? One of the biggest misconceptions out there is that small investments are not worth the time or effort. Many people think, why bother investing a few dollars, it won't make a difference. But the truth is, every penny counts. It's not just about the amount you invest, it's about the habit of investing. Even small investments can grow over time, thanks to the magic of compound interest. Take the example of a small seed. It may seem insignificant at first, but given the right conditions, time, sunlight, water, and nutrients, it grows into a mighty tree. Similarly, your small investments, when nurtured over time with regular contributions and smart choices, can grow into a substantial portfolio. Another common myth is that only large investments can generate significant returns. This is like saying, only big ships can sail the ocean. While it's true that larger investments have the potential for larger returns, it doesn't mean that small investments can't be profitable. They just need the right strategy and patience. Consider the story of Ronald Read, a janitor who amassed an $8 million fortune by consistently investing in blue-chip stocks over many decades. His story illustrates that you don't need to be a millionaire to invest, you just need to start somewhere, no matter how small. There's also a misconception that small investments are too risky, but risk and reward are two sides of the same coin. While it's true that all investments carry some degree of risk, it's worth noting that risk can be managed. Diversifying your investments, for instance, can help spread the risk. So, the idea that small investments are not worth it, or too risky, or can't generate significant returns is simply not true. Just like the little seed that grows into a mighty tree, your small investments can grow into a formidable portfolio. So as you can see, these misconceptions about small investments simply don't hold water. So how can you make the most of your small investments? Let's dive into the world of strategies that can transform your small investments into significant returns. The first strategy we'll explore is called diversification. Picture a basket filled with various fruits. If one fruit goes bad, the others remain unaffected. Similarly, diversification in investing means spreading your investments across different asset classes or sectors. This strategy helps reduce risk, as the poor performance of one asset can be offset by the better performance of others. However, bear in mind that diversification doesn't guarantee profits or protect against losses in declining markets. Next, we move on to the strategy of regular investments. This involves consistently investing small amounts over time regardless of market conditions. It's like planting seeds every season, rain or shine. The advantage of this approach is that it helps average out the cost of investments, potentially reducing the impact of short-term market fluctuations. But remember, regular investments require discipline and a long-term commitment. The third strategy is long-term investing. It's like nurturing a tree. It takes time to grow but eventually bears fruit. Long-term investing is about patience and persistence, allowing your investments to compound and grow over time. This strategy has the potential to yield substantial returns in the long run, but it also involves staying invested through market ups and downs, which can be challenging for some. Now let's not forget that each strategy comes with its own set of potential risks. Diversification can lead to diluted returns if not managed properly. Regular investments might strain your finances if not planned carefully. And long-term investing demands patience and resilience against market volatility. So, as you navigate your investment journey, remember to consider your financial goals, risk tolerance, and investment horizon. These factors will guide you in choosing the right strategy for your small investments. Remember, the key to successful investing, whether big or small, lies in the strategy. Now, where can you start your small investment journey, you may ask? Today, there's an array of tools and platforms designed to aid individuals in making small investments. Let's delve into some of the most popular ones, shall we? First up are robo-advisors. These are digital platforms that provide automated, algorithm-driven financial planning services with little to no human supervision. The beauty of robo-advisors is that they are typically lower cost than traditional advisors, and they often require a lower minimum investment. This makes them a great option for beginners or those with less capital. However, while robo-advisors can handle many of the tasks associated with managing an investment portfolio, they may not be able to handle more complex financial planning situations. Next, we have micro-investing apps. These platforms allow you to invest small amounts of money, often by rounding up your purchases to the nearest dollar and investing the difference. For example, if you buy a cup of coffee for $2.75, the app might round that up to $3 and invest the 25 cents difference. The upside of micro-investing apps is that they make investing feel approachable and non-intimidating, especially for beginners. However, it's crucial to remember that while these apps can help you get started, they are unlikely to help you reach significant financial goals on their own. Another tool to consider is online brokerage platforms. These platforms provide an easy way to buy and sell stocks, bonds, mutual funds, and other investment products. They offer a variety of tools to help you make informed investment decisions. While these platforms are often user-friendly, they do require a bit more knowledge and involvement than robo-advisors or micro-investing apps. Lastly, we can't forget about traditional financial advisors. While they may require a higher minimum investment, they can provide personalized advice based on your specific financial situation and goals. These tools and platforms can be your allies in your small investment journey, so choose wisely. Remember, the right tool for you depends on your individual needs, comfort level with investing, and financial goals. Now that you've learned about the power of small investments, what's your next step? It's time to reflect on what you've learned and consider how it applies to your own financial situation. Each investment journey is as unique as the individual embarking on it. You have the power to shape your financial future, and it all starts with that first small investment. Consider your financial goals. What are you hoping to achieve? Maybe you're saving for your child's education, planning for a comfortable retirement, or simply looking to grow your wealth. Whatever your goal, small investments can help you get there. So, let's start by setting a small investment goal. It doesn't have to be grandiose. It could be as simple as investing $20 a month into a low-cost index fund. Or maybe you want to start buying shares in a company you believe in. That's perfectly fine too. The key is to start somewhere and start small. Once you've set your goal, it's time to work towards it. And remember, investing isn't a sprint, it's a marathon. It takes patience, discipline, and a willingness to learn from your mistakes. But with time and consistency, you'll see your small investments grow. And as you embark on your investment journey, don't be afraid to seek guidance. Reach out to financial advisors, join investment forums, read books on investing. We live in an age where information is readily available at our fingertips. Use that to your advantage, so reflect on what you've learned today. Think about how you can apply these strategies to your own financial situation, and most importantly, take action. Because the best time to start investing was yesterday. The second best time is now. Remember, every great investment journey begins with a single small step. So, when will you take yours?